Have you ever wondered how fair value is measured for financial reporting purposes? Well, that's where the International Financial Reporting Standard 13, or IFRS 13, comes into play. This global standard provides a comprehensive framework for measuring fair value for both financial and non-financial assets and liabilities. But what exactly is fair value? In simple terms, it's the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. It's crucial to note that IFRS 13 doesn't dictate when to use fair value, but it does provide guidance on how to determine it when its measurement is required. So, IFRS 13 is our guide when it comes to determining fair value. Now let's delve deeper. Who are the key players when we talk about fair value? Well, in the world of International Financial Reporting Standards, or IFRS 13 to be precise, market participants are the stars of the show. These are the buyers and sellers in the principal, or most advantageous market for an asset or liability. Now, when determining fair value, it's important to remember we're seeing things from the perspective of these market participants, rather than through the lens of a specific entity. This means we're looking at the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between these market players at the measurement date. Essentially, this perspective shift keeps us grounded in the realities of the market, ensuring that fair value reflects what's happening on the ground in the real business landscape. So, it's the market participants that set the stage for fair value. Next, we'll look at the hierarchy of inputs. What's the order of priority when it comes to inputs used in fair value measurement? You might ask. Well, IFRS 13 lays out a hierarchy of inputs to answer just that. At the top of the hierarchy, we have Level 1. This level includes quoted prices in active markets for identical assets or liabilities. These are the most reliable inputs and require the least amount of judgment. Next up is Level 2. Here we're talking about inputs other than quoted prices included in Level 1. These inputs are observable for the asset or liability, either directly or indirectly. They provide a bit more room for judgment, but still, they're anchored in observable market data. Finally, we have Level 3, the bottom of the hierarchy. These are unobservable inputs for the asset or liability. In the absence of market data, entities must use their best judgment to determine these inputs. Remember, the hierarchy of inputs is crucial for determining fair value. Now onto valuation techniques. How do we actually measure fair value? That's a million-dollar question, isn't it? Well, to answer that, we need to talk about valuation techniques. These are the methods that entities are required to use to measure the fair value of assets or liabilities. Now, there's no one-size-fits-all technique. The technique used needs to be appropriate in the circumstances and should maximize the use of relevant observable inputs and minimize the use of unobservable inputs. Observable inputs are data that can be verified by market participants, while unobservable inputs are not directly verifiable and may include the entity's own data. There are three main types of valuation techniques. First, we have market approaches. These methods use prices and other relevant information generated by market transactions involving identical or comparable assets, liabilities, or a group of assets and liabilities. Second, we have income approaches. These techniques convert future amounts such as cash flows or income and expenses to a single current amount. Essentially, it's about determining the present value of future earnings. Lastly, we have cost approaches. These methods reflect the amount that would be required currently to replace the service capacity of an asset. In other words, how much would it cost to replace the asset today? Moving on, let's talk about changes in fair value. These changes are typically recognized in the income statement. This means that if an asset's or liability's fair value increases or decreases, that change gets reported in the income statement, affecting the entity's net income for the period. However, for certain financial instruments, changes in fair value may be recognized in other comprehensive income, which is a section of equity. Remember, the ultimate aim of these valuation techniques and recognizing changes is to provide the most accurate, reliable, and relevant information about an entity's financial position. It's about painting the most accurate picture of an entity's financial health. So, valuation techniques and recognizing changes are key. Lastly, let's talk about disclosures. What information about fair value does IFRS 13 require to be disclosed, you may ask? Well, IFRS 13 mandates comprehensive disclosures to ensure transparency in fair value measurements. These disclosures are designed to provide information about the measurement of fair value, the inputs used, and the level in the fair value hierarchy. Let's start with the basics. Entities must disclose the fair value of each class of assets and liabilities, along with the corresponding level in the fair value hierarchy. This hierarchy, which we've discussed earlier, comprises 3 levels. Level 1 includes quoted prices in active markets, Level 2 includes observable inputs other than quoted prices, and Level 3 includes unobservable inputs. For assets and liabilities measured at fair value on a recurring basis, entities are required to analyze the changes in fair value between periods and disclose the reasons for these changes. This analysis must be broken down by level within the fair value hierarchy. Now let's talk about Level 3, which requires additional disclosures due to its use of unobservable inputs. Entities must provide a narrative description of the sensitivity of the fair value measurement to changes in those unobservable inputs. In other words, how might the fair value change if these inputs were to vary? This information can provide valuable insights into the potential risk associated with the asset or liability. Entities must also disclose the valuation techniques and inputs used to measure fair value, particularly if there has been a change in technique. If a change in valuation technique results in a significantly different fair value measurement, entities must highlight this and explain why the change was necessary. To conclude, disclosures under IFRS 13 are all about providing a clear and complete picture of how fair value is measured. They aim to ensure that users of financial statements can assess the methods and inputs used in fair value measurements, and the effects of those measurements on the financial statements. As we've seen, IFRS 13 provides the principles for fair value measurement, but it's up to entities to apply them appropriately. Thank you for watching, and if you found this video informative, please like, share, and subscribe to Corporate Canvas.